short interest and swaps work specifically on AMC and Gamestop, but if accurate, this would be applicable to any stock on the market. What's going up? What's going on? Quiet. Drop TF. Felix, welcome back, ladies and gentlemen. It's great to see you. All right. So Noctis Research says, let's verify this for authenticity here, which I will do after I read the tweet. Are our buy orders repackaged into swaps? Market makers could be leveraging payment for order flow, PFOF, and internalization to repackage retail buy orders into equity swaps, effectively absorbing bullish momentum while disguising true market demand. Here's how this could work. 1. Capturing retail flow through PFOF and internalization. Market makers, such as Citadel and Virtue, buy retail orders from brokers using PFOF. Of course, that would be like from Robinhood, Schwab, E-Trade, Fidelity, Webull, you name it. Almost every single broker is using payment for order flow from these dark pool abusing market makers. He says they internalize these trades instead of sending them to public exchanges. 2. Synthetic shorting through swaps. Instead of borrowing real shares to short, hedge funds can enter into equity swaps with market makers. This creates synthetic shorts, where the hedge fund gets the economic exposure of short selling without directly reporting short interest. No shares need to be borrowed, so there's no short interest. Example, a hedge fund wants to short GME without increasing reported short interest. In order to do so, he says that the market maker internalizes buy orders, doesn't deliver real shares, and packages the held shares into a swap agreement. 3. The game, infinite liquidity via internalization and swaps. Since retail orders are absorbed internally, there's no pressure on the lit exchange price. Swaps allow hidden short positions, making it seem like short interest is lower than it actually is. This enables market makers and hedge funds to keep stock prices suppressed indefinitely without causing a squeeze. Now, having read this, let's take a look and see if this is accurate. Is this correct? What's going on, Fugazi? What's up? RuneScape own about 6,000 AMC shares now and buying more. Congratulations, my friend. What's up, Dufresne? Eagle Eye says, we're going to be so effing rich. And Creamy Goodness says, I picked up GameStop calls on the yearly 200. It is oversold and I couldn't help myself. Well, my friend, that could prove to be a very profitable strategy. Let's take a look and see if this is accurate. And the reason I bring this up specifically is because after I discuss this, I'm going to play for you this short 8-minute video of Jim Cramer. Some of you may have seen this, but most people have not, because this is from 2008. And in this video, Jim Cramer explains in great detail how one could potentially manipulate markets and exactly how the short and distort FUD campaigns occur. So let's see what this guy here is saying, what Noctis Research is saying, I should say, this entity. I don't know if it's one person or an actual company, right? I'm just sharing with you what they posted because I found it to be fairly intriguing. He says, our buy orders are repackaged into swaps. Market makers could be leveraging PFOF and internalization to repackage retail buy orders into equity swaps, effectively absorbing bullish momentum, disguising true market demand. All right, well, taking this into consideration, he says that capturing retail flow through payment for order flow and internalization, market makers buy retail orders from brokers like Robinhood, E-Trade, Webull, etc., Schwab, Fidelity. They internalize these trades instead of sending them into public exchanges. Now, according to all of the publicly available information about payment for order flow, market makers like Citadel and Virtue, etc., pay brokers for routing client trades to them. This is called payment for order flow. That is correct. This allows market makers to profit on the difference between the bid-ask spread and share a portion of this profit with the brokers as their commission. via payment for order flow. This is correct. Brokers like Robinhood, E-Trade, correct in saying that those are brokers that use it, along with the vast majority of others out there, including Fidelity, Schwab, Webull, TradeStation, Tastyworks. All of these guys, and then some, are using payment for order flow. So all of that is correct. He says they internalize these trades instead of sending them to public exchanges. And if you go onto the SEC.gov webpage on internalization, it explains that brokers can choose to fill an order from their own inventory instead of routing it to a public market or a market maker. So this is accurate as it matches the description provided in the SEC.gov post on their website about market makers internalizing trades instead of sending them to public exchanges. So yes, so far, the description of how market makers use payment for order flow and internalization to buy retail orders from these brokerages and process them internally is accurate based on these sources. And because they're doing so, I will add that it is not properly impacting the price of your stock. So when they internalize the trade, the stock price does not go up as it should. It does not go down as it should. They can also fail to deliver. They're giving you shares now, and they have to buy them back later, potentially making significantly more profits off that bid-ask spread by selling them to you now and buying them 28 days later, or even worse, failing to deliver. And in T+35, that shows up as an FTD. And if that happens for a large number of shares for a significant period of time for multiple days in a row, then that stock goes on the Reg Show threshold securities list. And we've seen both AMC and GameStop in the past on the Reg Show threshold securities list to great extent, sometimes for many dozens, if not even hundreds of days in a row. So all of this so far is accurate. Synthetic shorting through swaps. Now, equity swaps is when an investor can transfer the negative returns of an equity position without losing ownership of the shares or the voting rights. And this is done by entering into a contract with another party, where one party pays the return of the equity position. I'll explain that here in a moment. And the other might pay a fixed or a floating rate of return. I'll explain that as well. But before I do, let's analyze the rest of the tweet. This creates synthetic shorts where hedge fund gets the economic exposure of short selling without directly reporting it as short interest. No shares need to be borrowed, no short interest. So they're suggesting that hedge funds use this to short stocks like GameStop and AMC without increasing reported short interest because no shares are being borrowed in the process. And of course, this aligns with the concept of synthetic shorting, where the economic exposure of a short position is achieved without traditional short selling. So the explanation here of synthetic shorting through equity swaps, where hedge funds can short without borrowing shares and thus not reporting it as traditional short interest, is accurate based on the provided context. And so the post claims that by internalizing retail orders and using these sorts of swaps, market makers and hedge funds can suppress stock prices indefinitely without causing a squeeze. And this is inferred from the ability to absorb the bullish momentum by repackaging all of these buy orders into swaps, via the internalization, which reduces the pressure on public exchange prices. That is correct. And the hidden nature of synthetic short positions through these swaps, which could make short interest appear lower than it is, thereby potentially affecting stock prices. This is also correct, as most of those stocks are traded over the counter, which means it goes from one company's desk, for example, Bank of America, to another company's desk, for example, Citadel. Now, I'm not saying that that's exactly what's happening. I'm saying that that is very highly plausible. So while the mechanics of internalization and synthetic shorting here via these swaps are correctly described, the claim about indefinitely suppressing stock prices is, of course, speculative, and it depends on a variety of market conditions, the regulatory oversight, which a lot of people understand that there is very little to none, and other factors that are not detailed in this post. And the strategy of using these mechanisms to influence market perception and stock price dynamics is highly plausible. I've got to say that. It's highly plausible based on the understanding of these financial instruments. So the information provided in the post is largely accurate in terms of how payment for order flow and internalization and equity swaps work within the financial market context. The effectiveness and implications of these practices in manipulating market prices is, of course, complex and subject to broader market forces. So let's understand the mechanics of an equity swap. How could this work? Well, let's break down the processes into several steps. Real quick, let's understand the concept. Understand the concept of swaps. So an equity swap is a financial derivative contract between two parties where they agree on the exchange of future cash flows over a specified period. Now, what this means is that one party's cash flows are typically based on the return of the equity stock, here let's say Gamestop, while the other parties might be based on a fixed or a floating interest rate, LIBOR, SOFR, etc. So now, the parties, who's doing this? So party one, or party A, let's call them a hedge fund. They want exposure to GME without owning it. And party B, let's say this is a bank or the prime broker. Let's call them the hedge fund. Let's call them Melvin Capital. And again, these are just speculative, so let's call them Credit Suisse. You know what? Actually, let me just go ahead and change this to Archegos. Archegos was a family office, but it's pretty much a baby hedge fund. It's basically using their own money and their friends' monies. So this might be a financial institution or another investor who agrees to the terms of the swap. And they could probably be looking to diversify or hedge other positions. Let's go into step 3. Now they've got to make an agreement, right? So they have to agree on, one, the notional amount. This is the hypothetical principal. Hypothetical principal amounts, the dollar amount used to calculate the payments, but not exchanged. That's a hypothetical number. And then B would be the equity portion, say the first leg being linked to GME. And then C would be the interest rate leg. Let's say LIBOR or SOFR nowadays, a floating rate. And in which case, here, party A will receive this amount, and here, party B will receive this amount, for party A for the equity and party B for the interest rate portion of the swap. Now they will exchange cash, right? There has to be an exchange of cash flow. And it's they're not constant, but they're periodic payments. Let's say they are quarterly. They could be biannually, etc. Now, if GameStop outperforms SOFR, right, / interest rate, then party B, scroll down for you guys, would pay party A the difference between the return of the equity and the interest payment. I'm posting it up here because I'm going to pop this into Twitter, and I know some people like to read in order to be able to follow along. Now let's do example B here. If the equity underperforms, let's again, if GME underperforms, party A has to pay party B the difference between the interest rate and equity rate returns. So that's why it's called a swap, right? Because they're basically swapping back and forth the cash flow and the payments. Now, which one? That's 4. Now we're on 5. So they have to hedge and manage risk. How are they going to do this? Start with hedging. Party B, let's call them, they were Credit Suisse. It's going to hedge their exposure by investing in GameStop or using other derivatives such as futures, options, etc., to manage the risk. And B will be the risk. Both parties face the market risk, the credit risk. Of course, the credit risk is the risk that there could be a margin call, that the party might default. And if party B, Archegos, if party A, Archegos defaults, then party B, Credit Suisse, has to pay the difference. And a lot of people are still unaware of the fact that this is the whole reason why Credit Suisse required a government bailout and had to be purchased by UBS was because of the collapse of Archegos, who took out a majorly huge amount of swaps in stocks like GameStop and AMC to the short side. They also took over-leveraged swaps to the long side in other stocks. And then, of course, there's liquidity risk, insufficient cash, insufficient shares of stock, etc. And this is especially dangerous if the swap can't be unwound easily. And right now, UBS is having major troubles, in my opinion, unwinding the Credit Suisse risks that were legacy costs left over after the collapse of Archegos and CS. So that's what we're facing right now. And then what number are we on? We would be on 6. So the next stop would be after the hedging and managing of risk, ending of the swap, right? Let's call this termination of the swap. And that would either be at maturity, when it ends, end of the swap, agreement terminates, and no more payments required unless further terms of agreement are necessary. Or B, if they ended early termination. I see you, chat. I'll read it as soon as I can, guys. I'm trying to type and explain this at the same time. Swaps can be ended early if there's a mutual agreement or conditions are met. And settled based on final value of the swap. I'm going to try to keep it from going too long. And these things are highly customizable. 1 second. And of course, the OTC. Go for it, honey. You can play. My little one wants to play PlayStation. I told her to knock herself out. So these equity swaps are highly customizable with frequency of payments, type, index, stock, etc., and the interest rate benchmark, like LIBOR or SOFR, etc. And of course, they're traded in the OTC. Over the counter, these swaps go from private entity to private entity, never hitting lit markets. So they're non-standardized and they can be switched around and can be changed / customized almost infinitely to be traded on or traded on exchanges, but that almost never happens. Now let's think, how can they be used? uses, right? Synthetic exposure, like the short positions mentioned in the tweet. Synthetic shorts can be created to gain exposure to the downside of an asset's performance. And synthetic longs can be created to gain exposure to the upside of the performance on that stock as well. They have the ability to hedge. Now, oftentimes they would do this. For example, they can create synthetic short positions or synthetic long positions in order to hedge baskets of securities, either in these or in other securities that run in inverse to these, right? You could think of the SPY and the volatility index, for example, or Gamestop and AMC, for example, or Gamestop and the entire basket of those securities of heavily shorted equities versus stocks like NVIDIA, right? And just generally to hedge and manage risk. And now there's a lot of tax benefits for them here. And even, let's see. And market, not manipulate, even market manipulation benefits. Well, one could definitely say that. The swaps offer tax benefits and prevent short interest from appearing on a stock directly. In example, this is exactly what Melvin Capital failed to do against GME when they showed they had over 140% of the float in short interest. Melvin Capital got lazy. They got cocky. They thought they'd be able to crush GameStop. They started shorting the stock directly instead of shorting the exchange traded funds and products, instead of creating more swaps, instead of using married and divorced calls and puts in order to short the stock and create synthetic shorts and synthetic longs. They got cocky and they ended up going bankrupt. They went completely insolvent, and Citadel Securities had to bail them out with billions of dollars in order to prevent Melvin Capital from going completely under, knowing that Citadel Securities had a lot of exposure to AMC and GameStop. And if Melvin Capital would have gone under, there would have been forced buybacks of a lot of those short positions by the DTCC, for example, thus forcing the stock price even higher and creating a position in which market makers like Citadel and Virtue would further have to hedge their position by buying more shares of AMC and GameStop at a time where extreme volatility forced these brokerages and clearinghouses and market makers to collude to pull the buy button on January 28th, 2021. So they gave Melvin Capital billions of dollars in order to prevent that, in order to not lose tens of billions of dollars or potentially more, because the losses in short positions is not, there's no cap on it. It's infinite. It's infinite. You could lose everything you own, and your prime brokerage could lose everything they own, and the clearinghouse could lose everything they own, and all the way on up. That is why Archegos went bankrupt, Credit Suisse went bankrupt, and now UBS is facing a lot of those same risks. So I hope this gives you a better understanding of the financial strategies, the risk management, the investment, and the way that these things are actually happening. But now I'm going to, real quick, before I play this video of Jim Cramer on how hedge funds are scamming the market, let me just read your tweets real quick, or should I say your chat real quick, to see if you guys have any questions here. All right. Happy Friday, Purified. Hey, 401 Doge. It's good to see you, my friend. I'm not seeing any specific questions there, but Donkey Kong, welcome to the channel, brother. Welcome to the channel, Donkey. Jeffrey, thank you as well, my friend. I do what I can to share this information. So, all right, now I'm going to play you 8 minutes of Jim Cramer explaining exactly how these short and distort campaigns happen. Oh, look, I had this kind of off to the side. My apologies for that. Yep. All right. In case you couldn't read that on my screen there, Jim Cramer giving you all the dirty details on how he personally, allegedly, worked with others to scam financial markets. Let me zoom in a little bit so you guys can see this a little bit bigger. Now, granted, keep in mind, this is from old school TV, CRT TVs back in 2008. So this is from before we had HD. So no matter how high quality we'd like it to be, the fact is that this is as HD as it's possibly going to get. All right? Check this out.
Good to see you. Thanks for being here. There's a lot of economic data out today, but I want to talk about something else first. Again, today we have the misdirection from the futures. The futures pointing to an up market, and as of right now, stocks are down again. Is this just because it's the holiday period that we're seeing this?
You know, a lot of times when I was short at my hedge fund and I was positioned short, meaning I needed it down, I would create a level of activity beforehand that could drive the futures. It doesn't take much money. Similarly, if I were long and I would want to make things a little bit rosy, I would go in and take a bunch of stocks and make sure that they're higher. You know, maybe commit $5 million in capital to do it, and I could affect it. What you're seeing now is it probably is bigger market now. Maybe you need $10 million in capital to knock this stuff down, but it's a fun game and it's a lucrative game, and you can move it up and then fade it. That's often creates a very negative feel. So let's say you take a longer term view intraday, and you say, listen, I'm going to boost the futures, and then when the real sellers come in, real market comes in, they're going to knock it down. That's going to create a negative view. That's a strategy very worth doing when you're valued on a day-to-day basis. And I would encourage anyone who's in the hedge fund game to do it because it's legal,
right?
And it
it's legal.
It is a very quick way to make money and very satisfying.
Okay.
Well, by the way, no one else in the world would ever admit that, but I could care.
That's right, and you can say that here.
I can't. I'm not going to say it on TV.
Well,
you didn't know it was being recorded.
There's so many more hedge funds today than when you were managing your hedge fund.
Right.
Do you think that does that exacerbate the moves, or does it make it tougher?
Well, you know, the hedge funds are positioned long short, okay, not just long like mutual funds. So it's really vital these next 6 days because of your payday. You've really got to control the market. You can't let it lift. When you get a research in motion, it's really important to use a lot of your firepower to knock that down because it's the fulcrum of the market today. So I mean, let's say I were short. What I would do is I would hit a lot of guys with RIM. Now you can't foment. That's a violation of
foment.
Yeah, you can't foment. You can't create yourself an impression that a stock's down. But you do it anyway because the SEC doesn't understand it. So that's the only sense that I would say this is illegal. But a hedge fund that's not up a lot really has to do a lot now to save itself. So this is different from what I was talking about at the beginning where I would be buying the Qs and stuff. Right. This is actually just blatantly illegal. But when you have 6 days and your company may be in doubt because you're down, I think it's really important to foment. If I were one of these guys, foment an impression that research in motion isn't any good because research in motion is the key today. So you would hit this guy and that guy, and when you would see an offering, when you see a guy who's bidding, you'd wipe out that guy very quickly. And what I used to do was called, if I wanted to go higher, I would take and bid. And if I wanted to go lower, I'd hit an offer. And I could get a stock like RIM for maybe, that might cost me 15, 20 million. Annie, to knock RIM down, but it would be fabulous because it would beleaguer all the moron longs who are also keying on research in motion. So we're seeing
on today with
we're seeing that. That's again, when your company's in a survival mode, it's really important to defeat research in motion and get the Pisanis of the world and the people talking about it as if there's something wrong with RIM. Then you would call the journal and you get the bozo reporter on research in motion and you would feed that there's a Palm's got a killer it's going to give away. These are all the things you must do on a day like today. And if you're not doing it, maybe you shouldn't be in the game.
Okay. Another stock that a lot of people are focused on right now seems to be Apple.
Yeah, Apple's very important to spread the rumor that that both Verizon and AT&T have decided they don't like the phone.
Right.
That's a very easy one to do because it's also you want to spread the rumor that it's not going to be ready for Macworld. And this is very easy because the people who write about Apple want that story. And you can claim that it's credible because you spoke to someone at Apple because Apple isn't and it doesn't.
Right, they're not going to comment. They're not going to say.
So it's really an ideal short. And I would, again, if I were short Apple, I would be working very hard today to get that. And the way you would do that is you pick up the phone, you call 6 trading desk, and you say, listen, I just got off the phone with my contact at Verizon. And he has already said, listen, we're a Lucky G house. We're a Samsung house. We're a Motorola house. There's no room for Apple. They want too much. We're not going to let them in. We're not going to let them do what they did to music. And, I think that's a very effective way to keep a stock down.
Right.
I might also, by the way, because the stock at 84, 85, a little bit of capital, you go buy some January 80 puts that makes it look like there's going to be something going on. So maybe you give Morgan an order to buy 1,000 Jan 80 puts, then you go position limit with you use a firm that doesn't know what the heck it's doing. Maybe you go to UBS for puts. And you just kind of create an image that there's going to be news next week, and that's going to frighten everybody.
Right.
Then they all go out and say large put buyer UBS. And then they call Pisani again. You have to use those guys and say, listen, I see a big buyer of puts, and I'm told that it's SAC. You would do that too. And these are all what's really going on under the market that you don't see.
Right, nobody else talks about it except you.
What's important when you're in that hedge fund mode is to not do anything remotely truthful. Because the truth is so against your view that it's important to create a new truth, to develop a fiction. And the fiction is developed by almost anybody who's down like 2% to up 6% here. You can't take any chances. You can't have the market up any more than it is if you're up 6. Because starting Jan 2, you'll have all your money come out. So what would you do if you're in that situation and you feel like you're desperate? Is that you would do these actions.
So you're talking about the mechanics of the market.
Well, mechanics are much more important than the fundamentals.
Oh, okay, well, but in terms of the fundamentals, you've been writing about how you think.
Who cares about the fundamentals? Research in motion just blew out the quarter.
Right.
But look what people can do. I mean, that's a fabulous thing. The great thing about the market is it has nothing to do with the actual stocks.
Right.
Now, look, over maybe 2 weeks from now, the buyers will come to their senses and realize that everything that they heard was a lie. But then again, Fannie Mae lied about their earnings for $6 billion. So,
right, and Bristol Myers lied.
It's just fiction and fiction and fiction. And I think it's important for people to recognize that the way that the market really works is to have that nexus of hit the brokerage houses with a series of orders that can push it down, then leak it to the press, and then get it on CNBC. That's also very important. And then you have a kind of a vicious cycle down.
Right.
And it's a pretty good game. And it can be played. It can pay for 1% or 2.
Right, and then do you get long before Macworld and the expectation that the iPhone is going to be
down.
good? Right, and then you go back
You
flip to the long
certainly got
side.
to use the other side.
Interesting.
Yeah, and there's a case where I would say the January 80 puts can be justified because after I've knocked the stock down to 80, I can buy a lot of common, and then play it right into Macworld where they'll probably introduce the phone and Verizon's going to take it.
Okay. Well, maybe the fundamentals don't matter, but let's talk about the Fed
remember,
a little bit.
what Wall Street Confidential is not giving you the party line. Oh, here's the party line, by the way. I spoke to Apple. The phone. I hear the phones are good, and Verizon might take it. And as a matter of fact, the research in motion sellers, I don't think they know what they're talking about.
But you've been writing about the cell phone market. You think is you don't want to be involved in that.
The problem with the cell phone market, frankly, is that these guys are all killing each other. Someone has to take a dive. Motorola and Nokia have to get in a room and just fix price. They've been reluctant to do that because of the various justice departments and because
it's illegal, right? Yeah.
Well, that hasn't stopped a lot of other companies.
This is true.
This seems to be a case where they seem to be directly worried about the authorities. It's almost as if they have a lawyer that matters, unlike, say, the Bristol Myers lawyers. And what eventually happens is the shareholders demand that you get phony lawyers and you sit in the room. And it'll happen soon.
Real quick, the Fed, the numbers out today weaker than expected.
Oh, so what? The Fed has obviously got to cut. But again, you call the various guys who cover the bonds and you say, ignore the bond action. What's really happened is the Fed is very frightened about, and then you gin up the number that they're really frightened about. The Fed is actually desperate to try to figure out, how quickly they have to cut without looking like dopes that they raised.
Right,
in
because they've
May.
been talking about they're worried about inflation all this
You
last
don't
few
want
months.
to. You don't want to raise in May and then cut in January. You look like Mexico, for heaven's sake. I mean, this is like a distinguished group of people who went to really good schools.
Right, these are smart guys. Absolutely.
Yeah, they don't want to look like dopes.
But when we were talking earlier in the week, you said you think it would be some sort of crisis, possibly Ford being a trigger.
Well, Ford went and did all that, they pledged all this investment banking to all these guys. So now that they're very reluctant to say negative things, it makes it much tougher for the Ford story to play out. I mean, the amount of business that Ford has to do. Ford might be the big client of 2007. So if I were in the corporate finance room, I would say, listen to the research guy. I said, listen, I spoke with Mullally. I actually have the inside. The plan works. So then you're the research guy and you say, oh, man, what do I do? It's bonus time. I'm not going to be a total idiot. Spitzer's going to Albany. Let's get back in the game.
Right.
I think that's important.
Is it possible? Because a year ago at this time, a lot of people were saying GM's about to go bankrupt, and of course the stock's up 50-some-odd%.
Well,
Could Ford be that stock?
They're
57,
GM.
57,
No, but
57?
GM. The difference between Ford and GM was that GM's balance sheet was never really. It turned out wasn't that bad. Ford's balance sheet's pathetic, and you know that because they were willing to screw over the common for the bonds.
Right.
That's kind of if it weren't Ford, if this were Qualcomm. We'd be saying Qualcomm is desperate, But no, it's Ford.
But it's
so we
Ford.
say
It's an
fine.
American icon.
Yeah, I
and it's
drove
so,
a
right.
Ford. I owned a Ford once.
And this is our country. Well,
Yeah,
this
right.
has been Jim Cramer for Wall Street
Again,
Confidential.
what I'm trying to go for in the Wall Street Confidential, and I'm not saying you're sending me. I have to talk about what it's like at my hedge fund, okay? And what other hedge funds do, because the difference is that if this is an intraday show, and you need to know what I know is going
Right.
on. Now, we step back. Research in Motion was a real blowout quarter. It was a really good quarter, and I was quite surprised how strong the margins were. It looks like the other guys have really dropped out. It's a terrific story. Should it be up 6? Yeah, I think so. But, look where we are. It's Friday. You got 5 more days to make your quarter.
Right.
Can you really risk having RIM up this much? I don't think you can.
Okay, and they're not. And if I'm correct, you're off next week.
Yes, I am.
Okay, and I am as well.
right.
So we'll be back in 2007.
I'm hoping that
we
we finish the year at 1260 because that's at 12,460 because that's what I said at the beginning of the year was. Now yesterday we came in and we were 20 points away from what I predicted. I want to nail it.
Do you have a forecast for 2007?
Yeah, but I'm not.
You're gonna save that?
It's over a series of 5 days, so people have to go
All
to
right, people,
realmoney.com.
check it out on realmoney.com. And Jim, thanks very much for being
Thank you,
here.
Aaron.
I'm Aaron Task. Stay tuned for more of TheStreet.com TV.
There you heard it, folks, directly from Jim Cramer, from when he used to run his hedge fund.
Thanks for being here. There's a lot of economic data out today, but I want to talk about something else first. Again,
Real quick.
today we have the misdirection from the futures. The futures pointing to an up market, and as of right now, stocks are down again. Is this just because it's the
Listen,
holiday
just real
period
quick.
that we're seeing this?
A lot of times when I was short at my hedge fund and I was positioned short, meaning I needed it down, I would create a level of activity beforehand that could drive the futures. It doesn't take much money.
They create a level of activity. As you guys just heard in this, they often buy put positions or they put out articles or whatever in order to create activity in the futures market to make people think that something's going to happen. Of course, oftentimes nothing happens, but they want people to believe that to help manipulate the price, to help push the price in the direction that they want so that they can take profit. And we have seen already in 2025 a large number of short positions being covered in AMC and GameStop. Not all of them, not even close, not even fucking close. But we've seen a significant large number of positions being covered in GameStop, in AMC stock already for 2025. Tens of millions of dollars worth. And I went ahead and I explained to people exactly what is going on here so that you will understand why it is that what we're doing with Lit Exchange. What we're doing with Lit Exchange is creating a stock brokerage firm in which all orders are automatically routed to lit markets. Because when that happens, your order cannot be purchased using payment for order flow from other brokerages like Robinhood, Fidelity, Schwab, etc., like they are being right now. Because Lit Exchange, for example, will automatically route your orders to these lit markets to make sure that they hit the ticker tape, to make sure that they're not suppressed in dark pools, to make sure that your trade's not being front run, to make sure that the equities prices are properly being moved or changed as they should. There's a lot of positives to what we're doing here with Lit Exchange, and in my opinion, very, very few, if no, negatives. So if you want the opportunity for the first time in the history of the world to invest in an upcoming brokerage, and I say that because it's true. You can Google it, you can ask artificial intelligence. No upcoming stock and crypto broker has ever given you the chance to invest in the company via private equity before the company's launch and planned IPO, because this is usually reserved for big money, for hedge funds to make a shitload of money off of. As you can see right now, over 300 retail investors have 100% organically invested over $500,000 already in Lit Exchange. Now, I'm telling you now that this is the first time in the history of the world that this has ever been offered, and it may be the last. So if you want the chance to get in on the ground floor of a company, an upcoming stock brokerage firm, way before the IPO and before the launch, which we expect to come very soon, I cannot give an exact date due to regulations and regulatory requirements right now, but you have the opportunity to do so. And then when we're going to IPO, you also have buyer's rights in which you could buy more shares should you choose to do so at the IPO price before anybody else. Or you could sell the investment interest that you purchased in your private equity investment right now when we IPO, which of course could be also a potentially massive liquidity event. So I've got to get going. Make sure you go to litexchange.com, check out all the details there. Do yourself a favor. If you've got money to invest, of course, there's risk involved like any other investment, but it is all outlined there in our private placement memorandum, pitch deck, business plan, investment disclosures on the SEC Edgar website, and you can see it all for yourself right there and check out all the details, all the documentation. Ladies and gentlemen, I wish you peace and wealth. Have a beautiful weekend. Tyler asks, is it legal for those swaps and for Jim Cramer to do that stuff? Yes, my friend, it is legal. It is absolutely legal. Is it ethical? In my opinion, absolutely not. My 3-year-old is crying. I got to go. Cheers, my friends. Have a great rest of your day.